Am I on? Oh, awesome. Thanks, Chad. Thanks for the introduction and saving me the effort. So I'm JP Bryan. I'm Chad's sidekick. I get to live in his figurative shadow. But no, he's an awesome partner, and we love doing what we do. So thank you, LHPH, for the opportunity to be here today, and we look forward to talking to everybody. So we have a pretty short window here and a lot to get through, so I just want to jump right into the agenda and then cover our topics. So we consider ourselves the accounting professionals in the room, so it wouldn't be an update from us without an obligatory accounting and tax topic or two. And then for the remaining time we have together, about 20 minutes, we want to look at Lease Here, Pay Here profit, both at a singular lease deal level. Are we sure that our lease today still makes profit when we consider all the costs it takes to recover our investment? And what has changed to our lease in the last few years? And then blow it up to kind of a company-wide profit examination. What has changed since pre-pandemic? Why are we feeling it right now? And maybe what are some of the things we can do to mitigate that? Okay, first off, so that's a pretty bad color contrast there. Hopefully you can read it. First off, kind of the obligatory accounting and tax update here we're going to knock out. So a few topics. First one I have on screen is the credit loss standard. So beginning in 2023, this year, if you hold notes on your balance sheet, so retail installment contracts, capital leases, residual receivables, we've got to put a full loss reserve estimate on those notes. So we can no longer get away with, let's say, over time we write off 30% of our amount financed, 30% of principal. We can no longer get away with saying our reserve for future losses is 15%. Like, here's what's at risk for the next year. It's not adequate enough. This originated out of the Great Recession, the banking crisis of 08-09, when banks were underreporting future losses. It's finally come full circle to us. And so as you look at this, there's evidence you can provide to support what your reserve should be, like static pool loss charts, collateral recovery rate calculations. There's a lot of literature out there, and we're happy to speak to anyone about that. But I think the important key here is that if you have an adjustment to your balance sheet, because a lot of us are holding these notes, be proactive in talking with your lenders, your investors, your auditors about what that looks like. And it could impact banking covenants, and your bank might view your business a little bit differently as a result of this. Bonus depreciation. It's already been mentioned several times. I think many of us at this point are somewhat intimately familiar with it. But for a quick refresher, the Trump Tax Act of 2018 allowed for us to take 100% taxable deduction on eligible property. And our leases, our leased vehicles that are put in a first cycle, so new purchases, are eligible property. And as of 2023, that benefit starts to shrink by 20% each year. I think Brett mentioned it this morning. And so by 2027, we should be down to zero, absent some political intervention. There's silver lining to this. Each year we get to take something on top of bonus. It's called double declining depreciation. I'm not going to get into the nuances of that today, but suffice to say it should help mitigate the declining benefit of this. And if I think about a lot of dealers in this room, we are probably pretty profitable the last several years. Maybe 2023 aside, it's been a little bit tougher. But in a growing setting, we've recognized a lot of bonus depreciation and created these losses that we're carrying forward. We're going to start to chew through those. And while our buy here, pay here buddy down the street has paid a little bit of tax each year, even with creativity, we're not in that cadence, and cash flows are tight. So I guess I would say you should get with a tax professional, someone who knows kind of what they're doing, to see what that 1 to 3 to 5 year outlook looks like for you so you can plan for it. Employee retention credits, or ERC, you guys are probably familiar with this as small business owners. You may get a mailer or a phone call weekly from firms claiming they will qualify you for this, or at least try. It's overwhelming for some. So again, this one required a decline in gross receipts from 2019 to 2020 or 2021, significant. or it required you to be significantly impacted by a government mandate. And that part's very nuanced and jurisdictional. Most of us in this room probably grew, so our revenue, our lease payments, our overall grew, and so we're kicked out of the qualification on that gross receipts decline. But there's still another avenue with this government mandate deal. And I guess I would just say, if you have not yet looked into this program, we've seen varying levels of success. You still should, because it could be very impactful to your business. And last thing on that, there's currently, the government calls it a moratorium on new applications. That just means we can still apply for it. They're just not picking up new apps right now while they work through their queue. There's a lot of applications there. EV credits, I'm actually not going to spend much time here. I think we're all just very interested in what the future looks like and what heavy government incentivized rebates, refunds will stimulate EV production, and how does that filter into our model? I saw someone, I think actually it was Luke, on Facebook the other day, saying Tesla might be in my portfolio in the next 12, 24 months. I think it's fascinating. It's going to provide some challenges for us to work through logistically. Okay, let's get the heck out of accounting and tax regs and look at profit. So again, what we're going to do here is, first we're going to go through singular lease deal examples. We're going to look at 5 in total, and we just kind of want to capture all the revenue and expenses associated with the lease deals, and see if they're profitable or not, see what we're seeing. And so I'll be, for this part of the session, Joe Buck, and you'll be Troy Aikman. And anyone in the crowd is welcome to chime in as well. I encourage it. So I'll set the stage here. In this first example, we've got an 11.5 ACV. It's a gross profit of about 40%. It's going to go 2 lease cycles. The first lease cycle is 18 months or 18 payments with an initial net down of $1,375, $500 payment. Then there's a repo, a recon, and a recycle. And we're going to go another 8 months with a $900 net down payment and a $450 monthly payment. And so the last thing I want to point out here before we kind of open it up to analysis is the cost section of this diagram here, and how we look at this on our deals. In your case is very important to me, and in this case I've assigned some costs here. So for collectors, many would consider this pretty aggressive. We've got a collector paid $75,000 salary and benefits who's handling 400 accounts. That's a lot of accounts. We've got corporate overhead. I've got it in this example assigned at $20 per account. That's low. I'm almost certain of it. And then monthly debt interest. Many of us don't have super deep pockets. We're financing the purchase of this unit, and in today's rates, that equates to around $100 just in interest a month. And so that's just a reality of it. And so net profit $2,150. What do we see with this deal, and do we like it?
Well, I think one of the interesting, am I on? No? Hello? Okay. One of the interesting things on this, and I hadn't thought of it prior to looking at it just now, but this is the cycle that we've been in, I think, during the pandemic. For a lot of us, and you'll see in some other slides, I think, the profit actually being a little bit higher, but this idea of buying an 11.5 unit back in the middle of 2020, 2021 early, we keep a customer in the car now for 26 months. We've repoed it and recycled it once. But we were buying 110, 120,000 mile cars back in the early 2020 and 2021 cycle. And then we realized, hey, this car's got 150, 170,000 miles on it now, and we want to repo it and get it off of our books. But we really didn't make a huge amount of profit on this singular deal, where if we had kept that car for the full 36, 42 months, maybe over 2-3 cycles, maybe even 50, 2 months over 3 cycles, you'll see that profit start to go up. But we'll get to the next slides and look at that.
Okay, that same exact setup and structure only runs 18 total months. So we've got the first cycle is 12 payments, repo, recon, recycle, and the second one is 6 payments. And so you can kind of see, is that a, I don't want to mess anything up. There are a couple of offsetting factors, but not to our benefit. So in this circumstance, of course, we have a little bit less overhead to cover because it's a shorter term. And we're going to get a little more at auction at the end. The mileage isn't quite as high, and it's 1 year younger than if we had carried it another year. But that is not offset by our lost customer payments. In the first example, we collected almost 13 grand in customer payments. But those lost 8 months cost us almost 4 grand. We're down to 8,700 in customer payments. And so this turns into a break-even deal and probably doesn't get us where we want to be with this portfolio.
So we'll see it in future slides, but the key to the lease model is how many customer payments can I receive with the least amount of repos and the least amount of repo recon, right? So if I have a car for 60 months, let's say, and I I keep the customer in the car for 20 months, and I have 3 different customers to get to my 60, or did I have 4 different customers at 15 months? The name of I have that extra repo recon that's costing me in our model $1,250 that's going to come off of our overall profit for that vehicle. So we've really got to find a way to work with our customers to keep them in the car paying. Maybe that does mean deferring a payment or pushing a payment to get 5 more payments. I'd rather lose that one, keep them in there 5 more months, and then do that 2 or 3 times, but that takes out 1 additional customer, 1 additional repo, recon, commission, all of those things to make that car more profitable long term. I know firsthand there's people in this room that their average charge off, the customer goes to 20 to 22 months. There's some in this room that go 13 months. And that makes a huge difference on profitability, and we see that time and time again. So we really have to work on how do we keep the customer in the car paying, and deferments is a small tool to do that. Not to get carried away, not to enable our customer, but it is a tool that we do have to keep the customer paying.
And I think something you hit on a minute ago is really important to remember. This is still a unit by unit, customer by customer decision. If it's got 175,000 miles on it and you need to put a new motor in it, right, and try to hope that it doesn't have mechanical failure for the following cycle, is that worth it? And so it's very case by case sort of conversation, I think. Okay, let's move on. Example number 3, so a $7,500 ACV. So this is going to look a little bit more like kind of traditional buy here, pay here. This unit here has got 100% markup, 50% gross profit. But similar to our very first example, it's going to run 26 total months with 1 recycle involved. So we've got customer payment of $420 the first go around, $375 the second. Down payment $1,100 the first go around, $800 the second.
Go ahead and go to the next slide too. So $1,481 is kind of a profit on this unit. And the next one.
Well, before we go there real quick, I'll just say, our wholesale proceeds are way down because it's a much higher mileage unit.
Yep.
At the end of the second cycle, what's left? But yep.
We're back down to a $74 profit on this. And I think, again, the idea on these first 4 slides was to show what I think has been where we have been at the last 2 years in this market. And part of the reason, and we'll get into it at the end when we'll show a set of financials of comparing 2019 to 2013, or 2019 to 2023. But the whole idea is that, where we came in and got into that car in 2020 and 2021 just didn't give us as much profit to our bottom line as it previously had or in previous years for this model. Now, all these examples, we assumed the car was disposed in 18 and 26 months. Hopefully that's not the case with the majority of your portfolio, but there is a pretty large cross-section of your portfolio over the last 2 years that you've purchased that has fallen into this category, especially with the greater repos that we've now seen in the last 8 months.
And the intention here is to provoke thought. These aren't perfect examples, but I think 2 takeaways I hope that people are thinking about is, what is our average length to charge off? How many recycles do we get out of it? Many of us may be able to rattle that off the top of our head, but what about the overhead and the costs associated? I think that gets lost a little bit kind of in all the noise of the business. And so it could be as simple as taking your P&L, your operating expenses, removing interest, removing depreciation, and whatever that number is, spread it across your portfolio each month. What is that number to you, and how impactful is it in a singular lease deal sort of level? Finally, what we all strive for, and the beauty of the model, our original 11.5 ACV, going full term with those original parameters. We get total cash in the door of $23,000 on an initial 11.5 investment. Sure, our overhead has to be covered for a longer period of time, but we'll take it. The variable costs are so light compared to the benefit of getting it full term, and you can see we only pay a salesman once. We don't have any repo. We don't have towing and recon at all, and so $7,000 at the end of this is pretty great.
Excuse me. Really nothing to add here other than this is the ideal model. I guess the ideal model would be that they turn it in at 35 months and you do it a second time. But this is where we're looking for, or trying to get them to turn it in at 28 months, and flip into the next vehicle to retain that customer.
Okay, kind of our last topic here. Man, we need a marketing department. These slides are so inferior. Hopefully you guys can see this. So let's blow this up to company-wide. The idea here is to look at kind of what has changed with profit and cash flows from 2019 to today. Why are we feeling it? And then maybe what are some of the mitigating ways we can add back to profit, diversify our risk. So this is a fictitious example dealer. I'm going to kind of set the stage here. At the bottom, you can see a little bit of the parameters. So they started before pre-pandemic at 575 accounts, 6.9 million in principal and residual. Debt on that portfolio was 3.8 million, and their cost of capital at that time was 7.5%. And the monthly payment, this is probably a slightly lower ACV than maybe some of us are doing in the room, $400 net of sales tax. So fast forward to today, and these will be annualized numbers. It's not through August or something. Fast forward to today, 625 accounts, 8.1 million in principal and residual. And so our portfolio, dollars-wise, grew more than proportionally to our portfolio account-wise, right? Because we've got a higher ACV, higher amount finance, so our portfolio is growing even if the accounts aren't growing that much. Same goes for debt. Each unit we put out on the road is a higher ACV and more ask of our lender. And so, of course, the biggie, our cost of capital, even if we have some stuff fixed at a lower rate from 2 or 3 years ago, blending in the newer stuff, many of our effective cost of capital has almost doubled, so 12% in this example. And so I'll just walk us down here for a second to point out a couple things and open it up. Looking at top down in the P&L here, your P&L may look a little bit different. This isn't the template, the be-all, end-all. But our lease income, of course, has gone up a little bit. Our wholesale losses and our lease cost of sales, so wholesaling the units or liquidating our units out of lease, has gone up somewhat dramatically, to the point where our gross profit, despite the 15% larger portfolio, has barely ticked upward, right? It's more or less the same as it was. But what about overhead? The first one here, you could really probably call it part of the cost of goods, but the first one here is the after sale. This is a dramatic example. But I think a lot of us are feeling it with our higher mileage units. Tim's slide this morning was really good where it showed that we stayed in a 2014 model for 3 years. It's costing us an after sale in mechanical. We're coming back more frequently. Those are real dollars out of our door. And of course, there's cost creep across the board. Tim also showed the inflationary slide. Most of our costs across the board, rent, utilities, people, are up 15, 20% from pre-pandemic. And of course, the cost of capital, the interest expense. We've got the double whammy there where our rate has almost doubled, but in many cases we also have more debt because we're peddling a higher ACV. Maybe we've grown, maybe both. So when the dust settles, what has happened? In this dealer's case, I think you could scale it to your business, and many, hopefully not all, but I think many of you are feeling this scenario a bit. We made a lot of money, a good amount of profit in 2019, $500,000, and now we're back down to break even, and cash flows are tighter. And so it begs the question, those that aren't, what have they done to mitigate this credit crunch and actually make 2023 a better year than 2022?
So some of the things that, what can we do to help mitigate, the cash flow crunch and the costs? I think the Dan interview earlier was a good one, because I think there is a place to have a retail arm or side of your business with your buy here, pay here, or lease here, pay here dealership. I think it provides, you heard Dan talk about $6,000 grosses. That's not everywhere, but I think $4,000 grosses is, and you could see that a $4,000 gross compared to some of the numbers we showed earlier, you would have been ahead of the game a little bit there. I think long term, having a mix between the two is ideal. I think building a portfolio that you can gradually pay off and own over time, that's where the wealth creation happens. But having that retail piece that can supplement it and that can add a little injection of cash flow. I know it can be difficult to train employees and softwares and get all signed up with all the different third parties, but I think it has a place, and especially right now, to help with cash flow. Outside service income, if you have, shop employees are hard to come by. I don't think anybody here has a full shop right now, is my guess. But I think having that extra service income, if you have an extra bay or two, can you do some outside? So it's just about maximizing your resources and generating as much income. I always joke that maybe you should just set up a little bubble gum stand next to your payment counter. Every bit helps. But finding different revenue streams to add to your bottom line right now, though, is critical. And having wasted assets or wasted space, maybe you could sublease part of your building that you're not using, or something along those lines. Bring a tech in that can do outside work and your work. I don't know, but I think we're in a time right now that we're not going to go back to the 2019 and prior. Our cost structures are higher, and if we're not thinking through each line item on our P&L and where we can cut or how can we do something different, whether it's bring stuff in, outsource it, whatever the case might be, I think we're kind of kidding ourselves that we can outrun the expense structure that's before us right now. So charge off, collections, whether you maybe selling off, some of your notes. I'm not a huge proponent of that, but there might be a time and a place for that. Reinsurance products, a way to generate a little bit more revenue, per customer, to help cover your costs. And then attacking the most expensive debt first. Working with several of our clients right now on, taking some of the high interest debt. Maybe it's family debt that you've paid off 15% and they're willing to, and you have an avenue to get it down to 13% somehow, or refinance the real estate to pay off other debts at a higher rate. I think we need to think outside the box. I know we hate leveraging real estate. So many dealers hate that, but I think that's a huge thing right now to lower some of these 15, 16% rates that we're seeing, get it back down to 9 or 10. It's difficult. Banks aren't necessarily lending free. We've had a couple of declines in the last couple weeks with a couple of dealers, but I think just because that cash coverage ratio that Tim was talking about, or the interest coverage ratio, those things are really nailing us right now when we're trying to do some of this alternative financing with banks. But I think it's really time to take a line-by-line approach to your P&L and really have a hard discussions with employees and with yourself on where can we cut, because I don't think it's going to get any better anytime soon, unfortunately.
Yeah, that's good.
Was that like it for the talk?
Sure.
You're settling up?
Settling up.
Getting ready to.
Okay. 'Cause I'm waiting for like an encouraging word.
Yeah.
I was passing it back.
Oh, not my strength. I think we're all encouraged that if we're here at this point, we've kind of made it this far. That sounds pretty dramatic, but I think that there's a lot of good opportunity ahead, and we've talked about the potential better customer coming through our door, demand returning, possibly a return to tax time. And just having so much less lending competition to give us a better customer. So
we are seeing I don't know what I think for a lot of you, you're starting to see sales pick up a little bit. We're going to go back into a November, December normal time, I think, of collections being a little worse and sales not happening because of holidays. But I'm under the belief, and just the way things are falling, that we will have a tax time. I don't know what that. More than the last couple of years. And I think if dealers can get to tax time, I think they have a legitimate chance to kind of outrun some of the woes. But you have to outrun it with sales at the same time you're attacking your P&L and your expenses. So you can't, one doesn't save you. You have to do both of those. Any